Hello and welcome to the BOSS educational material. This video will introduce you to equity finance and to its relevance for a success of a business. Without financial resources, we cannot prepare a prototype or buy materials or travel to meet potential customers. When dealing with commercialization and use of an R&D results, there are different financial sources for funding our plan. Equity finance is one. Equity financing is a method of raising fresh capital by selling shares of the company to public, investors, or financial institutions. Unlike debt financing, which involves borrowing a fixed sum from a lender, which is paid back with interest, equity financing is the sale of a percentage of a business to an investor in exchange of capital. First, let's introduce some terminology and understand what the different types of equity finance are. Sweat equity. Sweat equity is a contribution to a project or enterprise in the form of effort and hard work by the owners. It is the preferred mode of building equity from cash-strapped entrepreneurs in their startup ventures, since they may be unable to contribute much financial capital to their enterprise. The term is probably derived from the fact that such equity is considered to be generated from the sweat of one's brow. Friends, family, and fools. Common abbreviated FFF or 3Fs. It's a reference to what is typical the initial source of funding for young startups. When the idea is still raw, waiting to be molded in something real, it's very difficult for entrepreneurs to secure investment for venture capitalists. Therefore, the best place to turn is to their friends, their family, and any fools that may be able to convince in their potential. Angel investors. Angel investors, also called business angels or informal investors, are individuals who provide starting capital for startups at the initial moments. Angel investors are often experienced entrepreneurs and professionals who can become valuable advisors to a young company. An increasing number of them are starting to operate in angel groups and angel networks, or to invest online in equity crowdfunding platforms. Cash contributions usually range from €50,000 to €500,000. Early stage venture capital funds. Early stage venture capital funds manage the money of investors who want private equity stakes in startup and small to medium-sized enterprises. Most venture capital comes from a group of wealthy investors, investment banks, and other financial institutions. To reduce default, the venture capital team works closely with the startup, enlisting the support of professional analysts on strategic management. The venture capital team can support the target company through further rounds of financing. Venture capital funds invest after break-even point to accelerate the growth, with investment that vary from €300,000 to €3 million in the early stage rounds to €5 million to €20 million in later stages. To access equity finance, it is important to have a well-prepared investment proposition. Investor readiness, that is the assessment of the maturity of the project to access finance and raise funds, is paramount to implement a commercialization opportunity and raise funds. There are some key determining factors for assessing whether an investor will or will not decide to invest in a startup. Is there a great team? Many investors consider the team behind the commercialization of research results more important than the technology, the idea, or the innovative solution itself. The investors will want to know that the team has the right set of skills, drive, experience, and temperament to manage the initial turbulences, deliver milestones, and grow the business. Is the market opportunity big enough? Most investors are looking for opportunities that can scale and become meaningful. So make sure you evaluate the market. Look at the expected revenues. Are they consistent with investors' expectations? One of the most important things for investors It will be designed for a measurable set of achievements, customers or users, that serves to prove that the solution matches a market need and that the proposed business model can be profitable. What is your unique value proposition? The team must clearly articulate why the innovative solution is unique or why it is much better than competition. Do the team understand financials and key metrics of their businesses? Investors look for teams who truly understand financials and metrics behind their business. Is the pitch deck professional and interesting? From the pitch deck, the investor hopes to see a clear and appealing description of the opportunity, with a clear business model and a committed and well-balanced team, all resulting in an investment opportunity with a high return. What are the potential risks? Investors want to understand what risks there might be to the business. They want to understand your thought-out process and the mitigation precautions you are taking to reduce those risks. Are the financial projections realistic and interesting? Investors want to invest in a company that can grow significantly and become an exciting business for them. How will the money be used? Investors will absolutely want to know how their capital will be invested and your proposed burn rate, so that they can understand when you may need the next round of financing. If you're raising money, you should expect these questions from any investor you get in contact with. If you want to know more about this topic, explore the educational resources provided on the BOSS platform. You can always get in contact with a knowledge transfer professional at your institution to discuss about your business opportunity and how to get in touch with investors.